I'm Dave Banis. Welcome to the first virtual trustee school. Just a little ground rules here. This is the first time that we've done something like this virtually, and hopefully it'll be many more times that we do this. So just to kind of go over what we're going to do here, I'm going to talk for about 45 minutes. We'll go through everything that I want to talk about. I've done this presentation probably a dozen times now over the last 5-6 years. And it's basically the same presentation with updated numbers. I'll talk for about 45 minutes or so, and then we'll take a quick break. So if any of you have questions, submit them in the chat while I'm talking, and we'll take a quick break. I'll look at those questions that we have, and then we'll spend about 10 minutes heading into the second hour, and I'll review some of the questions that I think are important for the group to experience and hear my answers to. And then we'll go another 45 minutes or so, and we'll do the same routine. We'll get to the last 10 minutes or so to highlight some of the questions that have come through. Next week, I think on Tuesday, we will send all of the participants here today the PowerPoint presentation and some other materials as reference points for all of you. And if after this presentation anyone would like to schedule a meeting with me or anybody else at our firm, we're happy to take your calls and schedule a time to chat personally. So all right, well, here goes. So everything you need to know about being the trustee of a special needs trust, and I mean everything you need to know. No, I'm just joking. Being a trustee of a special needs trust, being a parent of children, minors or adults with special needs, as most of you are well aware, is a very in-depth and complicated endeavor. We're not just talking about legal estate planning documents. We're talking about care coordination. We're talking about Medicaid benefits, and we're talking about Social Security benefits, waiver benefits. There are multiple levels of things that the trustee, a parent, need to consider. And then we think about, oh my gosh, what's going to happen? Who is going to be the person that's going to take care of all of this, all the knowledge that I've learned as a parent over the course of a lifetime, and in consultation with attorneys like us? How is my successor trustee after I'm gone ever going to get all of this? And I say that because I know that that's a real concern for everyone here. But my, I guess, word of encouragement is to use a cliche that's been thrown out a lot over the past 6 or 7 months now. We're all in this together, and we're going to be here to guide and counsel those individuals who you have named to take care of your loved one in the same fashion that we're doing now. So that's part of the reason why this presentation, this trustee school, doesn't change from year to year, because a lot of this stuff we just have to keep coming back to over and over and over again. I talk about the same things, Medicaid eligibility, first-party trust, third-party trust, the difference. I talk about the same basic principles of special needs estate planning day in and day out, and I presume I'll be talking about the same basic concepts for the rest of my life. And so while a lot of this stuff is going to be review, that's the whole point of it. So let's see. I'm trying to navigate my, there we go. Okay. So again, the goal today is going to be to review the basics of governmental benefits, Medicaid, SSI, some of the waiver benefits, and we're going to, again, review the basics, the eligibility basics over and over again. We're going to explore the relationship between those benefits, particularly Medicaid and trust administration. What does a trustee need to know about Medicaid and about SSI to effectively manage those benefits, maintain those benefits, don't do anything to interrupt those benefits? We'll talk about trustee responsibilities. Again, it seems like a daunting task to name, someone as a trustee. And so we'll talk about the responsibilities that are key. I'll also hopefully sort of dispel some of that, some of those fears that being a trustee of a special needs trust is something that anyone can't do. I mean, you don't need to be a special needs lawyer to be the trustee. I'm here to help. And usually the best suited trustee is going to be someone that understands the situation, and using the help of advisors like myself, like accountants and things like that, and maybe even referencing a letter of intent that you've put together for your successor trustee to carry out your wishes and the goals and the effect of the trust. And then last, we'll talk about trust administration, including the use of care managers to ensure the quality of life. And so trustee responsibility. So, you know, the question is, someone calls my office and says, my mom passed away. She was the trustee of my brother's special needs trust. And now I'm named as the successor trustee. I'm the acting successor trustee. Where in the world do I start? And, you know, you could read the document itself, but really the first place to start is meet with your attorney. Give us a call. Let's set up a meeting and we go from there. There's no reason to panic. There's no reason to think that, you know, there's a certain place that you absolutely have to start. There's not. Just start with a conversation, and then we, as you know, the attorneys, can say, okay, this is what we need to do first. This is what we need to do second, and this is what we're going to do in 30 days, 60 days, 90 days, and then administration going forward. These are the things you need to worry about today, and some of the things that you need to be concerned about or aware of going forward. Okay, so, you know, the main part of the main duty of a trustee is to oversee funds that are set aside, obviously, for an individual that has special needs. The trusts that we're dealing with are called discretionary trusts. Whether it's a first-party trust or a third-party trust, the trustees have sole, absolute, and uncontrolled discretion to make distributions on behalf of the trust beneficiary. And in fact, in a third-party trust, the language actually says my trustee may make no distributions whatsoever. And that's sometimes almost an alarming feature of a wholly discretionary trust, is that the discretion of a trustee is that broad. But it's for a reason. The obvious reason is that no entity, not Medicaid, not a creditor of the beneficiary, not any other family member, can invade that trust or compel the trustee to make distributions. So that language has to be there, but that also means that the trustee has really as much fiduciary obligation as any trustee can. So when you look at what the duties are over those finances for the trustee has a duty to invest the funds. Now, does the trustee have to be a perfect investor? Do they have to understand the stock market like a Wall Street trader? Do they have to be an expert in the field? The answer is no. And in fact, a trustee is expected to delegate those investment duties and advice out to someone that does know, you know, as much as they can know about that. But a trustee does have to be a prudent investor, and a prudent investor is someone that you don't want to put $1 million in a checking account that doesn't earn any interest. That's an imprudent investment. Prudent investing means diversification, sort of the basic duties that we would all think is prudent. There's an Ohio law called the Ohio Prudent Investor Act, and it actually says pretty much that. You need to be a prudent investor, but what that means is, again, the same sort of investment that you would do for yourself. That's the concept of a prudent investor. Then the trustee needs to be aware of how to make disbursements from the trust. We'll talk about this a little bit later, but the main sort of caveat is do not make disbursements directly to the trust beneficiary. No cash distributions. The disbursements obviously need to be for the sole benefit of the trust beneficiary, but they should be made directly to service providers. they should be made to directly pay for the products and services that that you want to provide for the beneficiary. A check written out to Best Buy to buy a new TV or a new computer, not a check written to the beneficiary to go to Best Buy and buy that TV or computer. Record keeping is another, I think, daunting concept for someone taking on the role of a trustee. And what I usually tell people about record keeping is you want to keep adequate records to be able to explain what you've done with the money and how you've made distributions to another lay person, a caseworker at Job and Family Services, a case manager at Social Security. As long as you can explain the money coming in and the money going out and what it was for, then that's adequate record keeping in my mind. You do not need to be a forensic accountant here, is in terms of record keeping. And in fact, you can obviously, and you probably should obviously hire an accountant to maintain the taxes. But from the perspective of Medicaid benefits and SSI benefits, what kind of record keeping do you need to engage in? You need to keep enough records so that if you're sitting across the table or across the computer screen in a Zoom meeting or something like that in the future, that you're able to describe, again, the money that was coming into the trust and then how it was distributed and for what reason. Reporting is a critical duty of the trustee. And who are we reporting to? We're reporting to Medicaid. We're reporting to SSI if SSI is in play. And what do you need to report? Annual reviews. They'll likely ask for the statements of the trust. So the bank statements. This is, again, how much money is in the trust. And on these statements, you can see the distributions. And, you know, if there are distributions to third parties, be prepared to be able to explain that, you know, this $500 fee was for Dave Banis for a consult. And although it was not directly to the beneficiary, or it doesn't seem like it's directly for the beneficiary's benefit, it was because the trustee was getting advice about Social Security or Medicaid or something like that. Another aspect of the reporting is, if you're particularly for a first party trust, for a Medicaid payback trust, for instance, if the beneficiary were to inherit some money, let's say $20,000, unexpected inheritance or something like that, and then the beneficiary places that money into the Medicaid payback trust, there's an obligation to report that to both SSI and to Medicaid. Technically, they say within 10 days. Practically, it is reported within 30 days before the next month, turns, particularly in the case of SSI, so you don't have any interruption of benefits. You're also, and I think we'll get through this a little bit later too, you're also supposed to report any change of circumstance, change of address, change of any income, change of any sort of disability status or anything else like that. And then everybody's favorite is taxes. Again, taxes tend to send people into a little bit of a panic, myself included. Nobody likes to file for them. Nobody likes to prepare them. Nobody likes to pay them. But death and taxes, right? So again, I would say taxes of special needs trusts it's a complicated issue, but it's not something that a good CPA can't handle with our advice, with our counsel. Usually just a couple questions about how the 1041, the fiduciary tax return, needs to be filled out. And there's a much longer discussion that we can have about how taxes in a special needs trust or a third-party discretionary trust impact benefits. And the only thing I'll say about that today is that taxes for the IRS and income that the IRS considers to be taxable income is completely different than the type of income that Medicaid and SSI is looking at. Medicaid and SSI look at earned income actually received in order to money, received in order to pay for one's care. If you're receiving income from work and that's money in an individual's pocket, that's going to have an impact on the receipt of SSI and in many cases Medicaid benefits. If an individual beneficiary shows that they had a few $1,000s of carried through or passed through income interest from a special needs trust, realize that that's an accounting report to the IRS to figure out who's going to pay taxes on that income, but that's not income that's ever been realized by the beneficiary, and therefore it's not going to impact Medicaid or SSI benefits because it's never been received, and that sort of income can't be used to pay for care. Okay. All right, then we move on from the financial responsibilities to advocacy. Sometimes we have a trust that just has a trustee and they're responsible also for the advocacy, representing the beneficiary in front of Medicaid or SSI. Possibly a trustee could also be the legal guardian of a beneficiary and obviously to advocate for the well-being of the individual. The trustee might also be the power of attorney. If guardianship isn't necessary and we're able to have powers of attorney in place, the trustee can oftentimes have that role as well. And, what is advocacy? Looking out for the individual, trying to do the best for the individual to help them succeed, to help them realize their dreams, their goals, their full potential. Advocacy can come in many forms and it can come from multiple people. So what we've been doing a lot lately is naming a beneficiary advocate directly in the trust. And that's someone that is separate from the trustee, someone that has the goal or the duty to really look out for the beneficiary and not have to worry about the money part, who might report to the trustee and say, our beneficiary here would really benefit from a vehicle, or our beneficiary here would really benefit from this sort of therapeutic device, or this type of physical therapy, this educational opportunity or something like that. And the trustee can say, okay, that makes sense, and let's get it paid for and let's get it done. And again, it's sort of a delegation of those duties so that one person isn't overwhelmed, is oftentimes where we're headed now in our planning. And it's comprehensive. The other thing we can do is we can name someone like Janelle Leonard or Hickman and Louder's Care Advocacy Services in the document itself to give the trustee the instruction that I want you to hire Hickman and Louder or another third-party care advocacy group or individual to be that person that's looking out for the beneficiary. Now, having a representing special skills or expertise raises the bar. What does that mean? That means that if I were the trustee of a special needs trust, my obligations and responsibilities, the bar that I have to meet is higher than someone who doesn't have those special skills or expertise. You would expect someone like me or an accountant to operate as a trustee in a more advanced way. That also means, practically speaking, that someone like me or an accountant acting as a trustee would be compensated more. I mean, there's a reason for that if you think about it. I mean, if I were acting as a trustee, I wouldn't have to engage with a special needs lawyer to know what to do. If you or your successor trustee needs counsel and guidance, they're going to use trust funds to go and get that from an accountant or a special needs attorney like me. So that is to say that anybody can act as a trustee. It's just, where do you get the expertise, the special skills? Where do you get that information and that knowledge? And so I would encourage everyone to not hesitate to name a close, trusted individual without special skills or expertise as a trustee, knowing that they'll be supported by us and others. Okay, fiduciary duties, self-dealing. The default rule is, of course, no self-dealing with trustee or immediate family members. And I don't want to spend a lot of time on this, but the reason why this slide is here is because most of the time we're dealing with trustees that are either parents, or after parents are gone, siblings, or other close family or friends. And we just want to make sure that if you're operating as a trustee, you're not borrowing from the trust for your own personal needs, that you don't have any personal investment or benefit from the investments of the trust or the trustee's business. The trustee shouldn't do any sales or purchases from the trust. Just as a general rule, it could happen. There probably have to be some pretty significant safeguards put in place to, again, protect the trustee from any view from others that was self-dealing. And of course, no commingling of assets. And again, that can be difficult sometimes when mom or dad is the trustee. They're taking care of their son or daughter like they have their entire life, and they're living as a family, and all of a sudden now you have to be very careful about some of these lines, these legal lines and things like that. So just no commingling of assets, wages, or any other income of the beneficiaries with the trust assets. Again, I've touched on this, and I'll sort of breeze through some of these slides, but the trustees or co-trustees may delegate duties amongst themselves. So if there's a co-trustee situation where, I'm a lawyer, my brother is an accountant, we may be co-trustees over a trust. My brother's going to do the accounting, I'm going to do the lawyering. That makes a lot of sense. And sometimes co-trustees, naming co-trustees is an excellent way to ease the burden and ensure efficient administration of special needs trust. But then, of course, the trustee could delegate to others. So again, a lawyer, an accountant, a care manager. The trustee doesn't have to do all this on their own, and they're not expected to do all of this on their own. It's just a person to execute the wishes of the grantor, of the settlor of the trust, and to facilitate the goals of maintaining benefits while using those funds to create the best life possible for the beneficiary. Let's see. Okay, I can move on to the next slide here. Investment. Again, I touched on this earlier, and I'm going to keep doing this throughout the day because I get ahead of myself and everything that's coming through my brain here. But the Ohio Prudent Investor Rule, it relies on modern portfolio theory of diversification. It's required unless the purposes of the trust are better served otherwise, or the agreement allows non-diversification. Delegation can be made to a reputable investment advisor, and that's encouraged. If a trustee is sitting on a good amount of trust assets, it ought to be invested with an advisor, an Edward Jones, a Fidelity, a trusted friend or something like that. And then when you are engaging with a private investor or an advisor, take a look at their investment policy statement to make sure that their investment policy statement conforms with this basic concept of modern portfolio theory and diversification. Again, you don't want to have all the trust assets with a hedge fund manager I don't even know what a hedge fund manager does, but somebody that's going to put it all in the riskiest places. So just look at the investment policy statements to make sure that you as trustee, when delegating that, are delegating it to someone that is going to follow these prudent investor rules. As for reporting requirements, again, there's two. I didn't mention this earlier, but there's also, in many cases, reporting requirements to the beneficiaries or their surrogate. Accountings, at least annually, It may be just a statement of trust assets and you list the income and the distributions for the year. You could include tax returns with that. If you are taking extraordinary trustee compensation, that ought to be disclosed to the beneficiary or their surrogate, whether that's a guardian, maybe that's even yourself. So a lot of this doesn't really come into play in close family affairs like this. But if you're looking at a successor trustee after you're gone, what are they going to have to do to the beneficiary? They ought to be prepared always to make accountings available for inspection and delivery to the beneficiaries, or maybe that advocate is a good person to review the accountings of the trust. It brings another thought to mind that a lot of times we'll name another person in the trust document as a trust advisor. So you could have a trustee, a trust advisor, and that trust advisor is going to again, look at the accountings, is going to, stand in place of the beneficiary to make sure the trustee is doing what they ought to be doing. And they might have particular powers to remove the trustee and name a new one. They don't have any powers to actually make the distributions or invest, but they do have sort of that control and oversight over the trustee. And then, of course, there's the advocate. So again, this idea of naming as many people as possible, if they're available and if it makes sense in a trustee to sort of lighten the burden of what everybody has to do, is what a lot of our clients have been choosing to do these days. I also don't want you to think that the trust advisor is in an adversarial role to the trustee. It could be the trust advisor, again, is someone that is going to advise the trustee, is going to counsel the trustee. And oftentimes the trust advisor is an attorney or someone with a little more sophistication and expertise in these areas, but may not be the appropriate person to actually manage the funds. And so that's all a good thing if you think about it. In some cases, and it's probably few and far between for a group like this, you may need to make reporting to the probate court. So a lot of times if there were birth injury cases and some sort of a settlement for an individual, a minor who was injured during birth, there would be a big settlement that would have to be approved through the probate court. And then you have to do annual or biannual accountings. And then if you need to expend any money out of those trusts that are in probate court, you need to ask for permission through an application for authority to expend. And then I already mentioned the reporting to the benefit agencies. That comes when they request it through an annual review, or SSI is supposed to do an annual review, but it's more like every whenever they want, 3-5 years, maybe it's every year, who knows. And again, that's just giving them what they want and being able to talk about it with them. A common question is, what does trustee compensation look like? Obviously, I think uniformly a parent trustee isn't going to be taking compensation. I mean, they might, particularly if it's a court-administered trust. But if we're talking about sort of a private Medicaid payback trust or a private third-party discretionary trust, typically parents aren't going to take compensation. They can, but they typically don't. The question arises when you've named a successor trustee to act after you're gone. Our compensation language says our trustee shall be entitled to reasonable compensation. Well, what's reasonable? Reasonable is sort of an ambiguous term that is used all the time in the law. Learned about the definition of reasonable in law school all the time. But reasonable for me would be different than reasonable for someone who owned a coffee shop. My compensation to act as trustee would be based on my level of experience and what I bring to that role. And so, again, all that is to say that reasonable compensation should be what is reasonable to that person, and there's no real standard. However, the probate court puts out a compensation fee schedule here, and this is the slide with that example. Again, this doesn't really come up a lot in practice or practically. It comes up a lot conceptually when we're designing the trusts. And you can do anything you want in the trust. You can say no compensation at all. If you wish, you could say reasonable compensation not to exceed X number of dollars. So you can set compensation however you desire. Okay, so what makes trust administration of special needs trusts special or different from trust administration of any other trust? Well, it's obviously the special challenges that arise as it relates to the beneficiary, the possible involvement of the court, the benefits that the beneficiary is receiving, all of the things that we're talking about. The likely diminished primary beneficiary capacity. So when we say diminished capacity, that might be physical, it might be mental, it might be both. And so you're not just cutting a check again to the beneficiary of a trust like you might do if you were administering mom or dad's estate. You're making sure that when you're making distributions that you're not violating the rules as it relates to their Medicaid benefits and their SSI. So it's obviously a heightened duty of things that you need to worry about. You need to be concerned with the status of the state of Ohio as the beneficiary's creditor or super creditor, particularly in the Medicaid Payback Trust. Remember, the Medicaid Payback Trusts are funded with assets that belong to the beneficiary and are placed in the Medicaid Payback Trust to maintain benefits. But if that beneficiary passes away, anything left in that trust is going to reimburse the state. So they're essentially a super creditor to anybody else. And there are rather sophisticated strategies to administer a Medicaid Payback Trust to minimize the state of Ohio's ability to come back and get that after the death of the beneficiary. And then there's the planning that totally cuts the state out, and that's the third-party discretionary trust planning that many of you are very, very familiar with. The primary beneficiary may have outlying income needs, high or low, and again, we're administering discretionary trusts. So there's nothing in these trusts that says this beneficiary is going to get $500 a month for the rest of their life. If we did that, it would violate the essence of what a special needs trust is. It would interrupt benefits. It would be likely counted as an available income or asset to that individual. So when there's no specific instruction in the document to the trustee on how much of a distribution to make monthly, annually, or at any time, the trustee needs to pay close attention to the beneficiary's other means and levels of support. Again, their income, what other supports do they have from family or Medicaid benefits or waiver benefits and Social Security disability and things like that. So trust administration in the special needs world is completely different than what we would call typical trust administration. Again, sort of breezing through this, ascertaining benefits, verifying the benefits that the individuals are receiving. I mean, the Medicaid benefits are confusing even when we're talking about base Medicaid. But then you throw in the waiver benefits, the special income limit for those with waiver benefits, the Medicaid buy-in for workers with disabilities that has different income and asset limits, SSI versus SSDI, Medicare versus Medicaid. Understanding which benefit the individual is getting so that you know as a trustee which benefit you need to protect is oftentimes one of the most difficult things starting out. And so good record keeping on those benefits is really important if a new trustee needs to step in and know what to do. A trustee of a special needs trust needs to understand what care the beneficiary may need. Caretaker selection, oversight. What are you going to do if there's an emergency? Are you worried about liability if the trust owns a home and other people are living in the home or renting from the home? A lot of different concerns that a typical trustee, again, might not have. And I'll skip down to the review and adherence to the letter of intent. A letter of intent is something that can come in many forms. It can be a letter from you as the person that's creating the discretionary trust or the Medicaid payback trust that says, basically, look, I can't put everything that I want in the trust because the rules state that it has to be for sole, absolute, and uncontrolled discretion. I can't say I want you to use this to buy a house. I can't say that I want you to give the individual, through a stable account, $500 a month. If I say that in the trust, it's going to not be a valid exempt trust for Medicaid and SSI. But here's a letter that I'm writing to you that says, this is what I want you to use the money for. It's not legally binding, but it is it's a message to your successor trustee. This is why we set the trust up, and this is what I want you to do with the money. It can also talk about anything else you want to talk about, your cultural and or religious desires, lifestyle desires, educational desires. People, I don't know if anybody's ever heard of an ethical will. Ethical wills are sort of coming back into style these days. And an ethical will is, you have your last will and testament that takes care of your stuff. Your ethical will is a document that passes down the intangibles in life, whether that is, again, religious sentiments, practices. It might be, my grandfather used to sing all of us grandkids, all kinds of silly songs when we were kids. And so we had him do a videotape of him singing all these silly songs that we had heard. And he's 93 years old and still doing fantastic. But that's in a sense, an ethical will that we're going to have that after he's gone. My point is, you can put whatever you would like in a letter of intent. It's something that you it's not something I can create for you. And it's also a great guide for the trustee to use to fulfill your desires for your loved one when you're gone. Okay. Okay, so let's start getting into some basic disbursement rules. If the trust beneficiary is receiving needs-based benefits, Medicaid and SSI, then again, payments made directly to providers of goods and services, that's a must. No cash whatsoever to the beneficiary. And for SSI, when a beneficiary is receiving SSI, you do not want to pay directly for food and for shelter. Otherwise, it will reduce the SSI benefit, okay? And so what we can do now, particularly for payment of food and shelter, is if the beneficiary is eligible to have a stable account, you can put money from the trust into the stable account and then pay rent out of the stable account. And that's a great new development that solves a huge problem that we've had for decades with the SSI rules and any sort of a special needs trust. Otherwise, SSI is going to look at that payment of rent or for food as what's called in-kind support and maintenance, which we'll talk about a little bit later. Assets in a trust. The parent's intent may be for a beneficiary to remain in the home for as long as possible. And so issues that come up with that are who are going to be the care providers once mom and dad are gone, who's going to take care of the home itself, who's going to mow the lawn, who's going to pay the utilities. Are there going to be roommates? And if there are roommates, how are they going to be legally protected? How's the trust going to be legally protected as a landlord? There's a lot of considerations as far as liability goes in that respect. And then, of course, insurance it's one thing to have a trust in a home in the trust, but a home in the trust with no cash to pay the insurance, the utilities, the taxes, and things like that. That's a consideration that we have to look at. Many times a vehicle will be titled in the trust, but again, we have the same sort of liability issues. Who's covered as a driver under the insurance? Oftentimes, to get around some of these practical issues, the vehicle will be paid for by the trust. We'll put it in mom or dad or another caretaker's or even the individual's name, and the trust will take back a lien on the vehicle so that if something happens to it or if it's sold, the trustee recoups its investment, basically. Insurance-wise, if the trustee or other family member is the primary caregiver, you want to purchase insurance on that person's life, life insurance on the caregiver's life. Having said that, there's some discussion in SSI circles that is an issue. I don't think it is legally, but the Social Security Administration has challenged us a couple of times on those provisions in trusts. And then prepaid funeral arrangements. It's nothing that anybody really wants to consider for ourselves or for beneficiaries, but certainly a trustee may decide to go ahead and purchase the prepaid funeral arrangements for the beneficiary. All right. A brief word on taxation of trusts, and I do mean brief. Again, I wrote an article in the Cleveland Metropolitan Bar Association's their monthly journal about what I mentioned earlier, the difference between IRS taxable income and countable earned income for Medicaid and SSI benefits. And so I don't want to get too far in the weeds with taxation on this because it has to be paid attention to, but oftentimes I'll talk about taxation of special needs trust from an IRS perspective, and people get worried that income is going to be considered by Medicaid or SSI as received income and it's going to violate benefits. So again, something we need to look at and needs to be considered, but I just want to give that distinction here. So most Medicaid payback trusts, first party special needs trusts are considered grantor trusts, which means that any income is passed through to the beneficiary and goes on the beneficiary's tax return. Okay. Most Medicaid payback trusts that I establish for our clients will get a separate EIN number for the trust, but you don't have to. It can be under the beneficiary Social Security number precisely because of what I just said, which is the income is going to be taxed to the beneficiary anyway. I'd like to have it separate with an EIN for reporting purposes. It's easier to explain to Medicaid and to SSI that this is a separate entity when it has its own EIN number. But every case is a little bit different, and we can obviously talk about what's most appropriate there. Again, if there is a separate EIN, the trustee will file an annual 1041, an informational 1041 tax return indicating that all the income will be included on the beneficiary's tax return. So, okay, we're getting close to our 45 minutes. So let me get through the taxes and then we'll take this is a good place to break for 5 minutes and then address some questions. So I already discussed that. Third-party trusts, the wholly discretionary trust, the trust that mom and dad are setting up for their family, which has the discretionary trust sort of in it after they pass away for the beneficiary. Those are not grantor trusts. So at the grantor's passing, you need to get a taxpayer identification number, and every year you need to file that 1041 tax return. It's classified as a complex trust, and it may get some tax benefits and deductions because it can qualify as a qualified disability trust. The income tax return will include all the income earned and reasonable administrative expenses can be deducted. Undistributed income is taxed to the trust. And the reason why I mention that is because the numbers are, I'm going to say the numbers generally. Generally, if a trust is earning more than $12,000 or $13,000 in interest an interest income and it has to be taxed to the trust, that's at like a 37% rate. Whereas if you can distribute it out and keep that income below that threshold, you're going to save a lot of money on taxes. So this is really a sort of in the weeds that you need to have a meeting with your accountant probably annually to say, okay, this is what we think the interest income is going to be. So this is the amount of money that we want to distribute, the income that we want to distribute out in order to lower that marginal rate. Okay. Okay, so I'm going to take a 2 or 3 minute break to review some of the questions, and then I'll be back to answer some of those questions. So I'm going to, let's see.
I was just keeping notes where they were.
Okay, so there's 8 or 9 questions here, and I figured I'll just go through them and try to answer them the best way I can. So the first question is, am I going to differentiate between SSI and SSDI rules on these points? And I will, and I'll do that in the next half of this talk. We'll go through all of that. Next question, can I think SSI money be transferred to a special needs trust to maintain Medicaid requirements and other bank accounts? So yes, SSI income that you get every month, that the beneficiary gets every month, can go into a Medicaid payback trust in order to keep the bank account below the $2,000 mark, or you can transfer it into a stable account if a stable account is set up, or you could spend it on things that you need. But since if the beneficiary already has a Medicaid payback trust, or if the beneficiary qualifies to establish a stable account, you can take that accumulated SSI income that the beneficiary gets every month, and instead of, in some cases you have to rush around to try and spend it down quickly so you're not over the $2,000, you can put that in the Medicaid payback trust or the stable account, and it can, since those are exempt assets, that can go well over $2,000, and that's the whole goal. So there's a lot of new opportunities, particularly with the stable account, to keep that money and not have to just spend it and spend it and spend it for no reason. Okay. Next question. Does the money in a special needs trust go to the state upon the beneficiary's death? The answer is yes. In a Medicaid payback, and I'll go through this in the second round or the second half in greater detail, but a Medicaid payback trust is called a Medicaid payback trust because it pays back Medicaid at the beneficiary's death. And the same goes for essentially a stable account. A stable account has a Medicaid payback requirement. It's a reimbursement. Keep in mind, it's a reimbursement. It's not just a blanket payback. So if the individual, if Medicaid is paid $25,000 in Medicaid benefits over the course of an individual's life, and there's $30,000 remaining in the Medicaid payback trust, Medicaid will be reimbursed, and then the remaining money will go to whomever the trust dictates. If there's not enough money to reimburse the state, then the state gets what's in there, and that's it, obviously. I will differentiate next hour, though, there's no Medicaid payback for third-party discretionary trusts. Third-party discretionary trusts are trusts set up typically by mom and dad, designed to hold assets that have never belonged to the beneficiary. So mom and dad's money that they want to pass down after they're gone, that's a third-party trust. You cannot put any money that has belonged to the beneficiary into a third-party trust once it's established. So from the prior question, can SSI money be transferred to a third-party discretionary trust? No. It can only go into a Medicaid payback trust or a stable account. Okay. Specifically with SSDI services, income levels of parents tend to knock younger people out of being eligible for services. Is it possible to get around the income limits by using a trust so services can be given to young children when they need it, rather than having to wait until the person is 18 and income requirements look at the disabled person's income only? That's a good question. So what that is getting to is that when a disabled individual is under the age of 18, for SSI and for Medicaid, unless we're talking about a waiver, a Medicaid waiver, mom and dad's assets and income are deemed to be that child's income and assets. And so it's very rare. I'll say it's rare. It's not very rare, but it's rare that an individual under the age of 18 is going to receive SSI because mom and dad have more than $2,000 in countable assets, and mom and dad have far much more income than $783 a month. There's no way to get around that unless, for SSI, there's no way to get around it. For Medicaid, if you apply and obtain a DD waiver, one of the things that they're waiving in the waiver is the deeming of mom and dad's assets and income. So there are many, many cases of an individual under the age of 18 being on Medicaid and receiving waiver services because they waive that deeming requirement for that. But really can't get around the mom and dad's income and assets being counted to the individual. So, and I'll talk more about that, I think, in the second half. We might need another hour, but I'm just kidding. All right. My son has been on SSI, or I don't know if it's a son or a daughter. He worked part-time for years and is now under review for SSDI. Any trust changes required if he moves from SSI to SSDI, and what happens if he earns out of SSI? Okay, so good question again, and it's basically, to recap, we're talking about the difference here between SSI and SSDI. And actually, I'm going to wait to answer this question that I just mumbled to you all for the next hour, because I'm going to go over, I think that question's going to be answered. Okay, and then there's a tax question. If a trust has $1 million in investments and yield 50,000, how do we avoid paying the 37%? Well, undistributed income is going to be taxed. So one way to reduce that is to distribute out $50,000 for the beneficiary's needs. That's if it's a third-party discretionary trust, okay? And that was the most general answer that I'm willing to give on that question, because that's a very basic answer. But again, going back to that slide about taxes, undistributed income out of a third-party complex trust is going to be taxed. And so if you distribute out the income, you can reduce the overall taxable income of the trust. Okay, last one. We're trustees for our daughter's special needs trust with an EIN where monies have accumulated. Plan withdrawal in future for replacement vehicle. We will add our funds to complete the sale. Car will be in our name. What do we need to file? I don't think that there's anything you need to file or report unless asked by the Medicaid or SSI agency. And maybe I misunderstood the question, but I don't think there's anything particular with taxes that you'd have to file if the car is going to be paid for by the trust, or partial monies from that is going to be paid for by the trust. And so I'm sorry, I can't get too specific on that, but these were good questions, and I appreciate them, and keep them coming for the next one. So I'm going to share my screen again, and here we go. Okay. You see the slideshow again? Okay. Okay. I'm going to breeze through some of these. And I mean, when I say breeze through them, I've already talked about a lot of this stuff. And so I want to get to the actual nuts and bolts of benefits. Okay, this is where we want to be, so we weren't too far off. Disability, the definition of disability is and this is from Social Security standpoint. It's the same standard that Medicaid uses, and so it's the Social Security standard for disability. Physical or mental impairment that persists for 12 months or longer, or will result in death, that prevents the individual from engaging in substantial gainful activity. Substantial gainful activity is $1,260 a month in earned income gross, okay? So again, an individual has a physical or mental impairment that is 12 months or longer, and it prevents that individual from earning $1,260 a month. If that is the circumstance, then that individual is going to be deemed disabled by Social Security. If that individual is earning $1,350 a month gross, and it's, repeatable, I mean, on average, then notwithstanding whatever's going on physically, mentally, or otherwise, they will not be determined disabled by Social Security's standards, which means that there will not be access to either SSI or SSDI. So once disability determination is made, then you're going to look at what benefit the two that I just discussed are going to be, that the beneficiary is going to be eligible for. The first one we're going to talk about is Social Security disability insurance. And that, again, is you have to meet the disability standard. And if the individual has paid into the Social Security system through wages in the past, then their Social Security disability benefit is going to be based on their payment into Social Security. It's basically accessing Social Security early retirement based on disability. It's not means tested, meaning excuse me. It's not means tested, meaning that the The $2,000 asset threshold, it doesn't matter. And other income requirements don't matter, but they're looking at earned income, so that substantial gainful activity is always relevant. Again, just to go back to the basics, if the individual is able to earn more than the $1,260 a month gross in earned income from work, then they won't be eligible for Social Security disability. Social Security disability is linked with Medicare. So after obtaining SSDI and 24 months passes, then that person is going to be enrolled in Medicare, the same Medicare that an individual gets when they turn 65. Medicare is also not means tested. Now, Medicare doesn't pay for everything, and Medicare doesn't pay for nursing home care, doesn't pay for waiver services and things like that. So we're always still concerned with maintaining asset, exemptions and the use of the special needs trust, because we always want to protect Medicaid eligibility. But if an individual can get SSDI, that is obviously preferable, because the amounts are going to generally be higher, and you don't have the reporting requirements to SSI. You don't have so much of what you all are aware of, the almost maddening letters that you get from SSI saying that you were overpaid 6 of the last 12 months, and now there's an overpayment, and here's the envelope to return the check to us. It's due upon receipt and all of that. So the other thing about SSDI is that if the individual hasn't worked, but their parent, and they were determined disabled prior to the age of 22, when their parent retires, becomes disabled themselves, or dies, then the child can receive childhood disability benefits, meaning they can get SSDI based on mom or dad's payment into the Social Security system. So this really brings up this critical age of 22, that you can establish if you can establish disability prior to the age of 22. It's huge, because when then mom or dad retires and starts getting their own Social Security benefit, their son or daughter is going to get Social Security disability and the Medicare that comes along with that 2 years later. And that's at a rate of 50% of what mom or dad gets in their paycheck and their Social Security benefit. And then when mom or dad dies, that 50% goes up to 75%. So we're talking about substantial and significant money over the course of one's life, if they're able to qualify as a child, as an adult disabled child, to achieve Social Security disability eligibility. Okay, then we go back to the dreaded SSI discussion. I mean, SSI is, it's certainly not a benefit that we want to ignore or dismiss, but it's difficult. It's difficult to manage. It's difficult to work with. The Social Security Administration is extremely picky these days on just about everything. And so a lot of times it's a real pain, to be perfectly honest. Again, getting letters from SSI about, overpayments, and they're misconstruing trust assets as available assets, and you can't communicate with them very easily. And it's difficult to navigate. And I have my own frustrations every day with SSI. I can't imagine what you all deal with. And I know many of you in this room, or in this Zoom room, are very familiar with what I'm talking about. But anyway, SSI is a means tested benefit. $2,000 is the asset or resource cap. And then, of course, any earned income. We'll talk about how that impacts the benefits. The eligibility for SSI and Medicaid are exactly the same. Now, Medicaid, I mentioned earlier, has a few different programs that vary from the Medicaid Buy-in for Workers with Disabilities program. That has a higher asset threshold than $2,000. The waivers and assisted living Medicaid have a higher income threshold than the $783 and the other deductions. So, but base Medicaid, if you receive $1 of SSI benefits, you're automatically qualified for base Medicaid. So we'll kind of talk about those eligibility requirements interchangeably. I want to make a distinction here between income versus resources. Income is what you get from either a paycheck or maybe an SSI benefit. The receipt of assets is income in the month it's received. So if you get a $783 check in August, August 29th is today, you get that money in your bank. That's going to be income for the month of August, but come September 1st, that is viewed as an asset. So that $783 is not an asset in the month it is received. It will become an asset the next month. So that's often a difficult concept to kind of come to terms with. For SSI, they do have a disregard of $20 a month of unearned income. I'll go through an example here to flesh this out a little bit. And then there's a disregard of $65 a month plus 1/2 of earned income. Impairment related work expenses and deeming, and then this in-kind support and maintenance are one of the reasons why, particularly with SSI benefits, it's really so difficult to manage with the agency itself, because they're only looking at these cases once every year at the most, and then they're trying to go back and figure out month to month whether or not an individual was underpaid or overpaid based on a lot of this, you know, what you see on the screen here, and it's just not an ideally managed program, but it is what it is, and we have to know about it. We talk about the in-kind support and maintenance. That's when your son or daughter lives with you and is receiving SSI. That living rent-free and eating food out of the refrigerator, the Social Security Administration considers that to be income to the individual, and so they'll reduce the SSI benefit. And the way to get around that, as we've said, or as many of you know, is to put in place a room and board agreement, or tell the Social Security agency that you are charging rent of the share of the household expenses. Again, resources versus, you know, as opposed to income, it's you know, cash, anything convertible to cash that is owned by the individual and available to the individual, and not exempt. One of the reasons why special needs trusts are not considered available to the individual and they're exempt is because, as I said in the very beginning, no one, not the beneficiary, not Medicaid, not a creditor, no one can compel the trustee of any of these trusts to make a distribution, and therefore it's unavailable to the beneficiary, and that's precisely why it's exempt, along with the other requirements, particularly of a Medicaid payback for first-party money. We've talked about deeming, and so I'll move on. Now, there's a lot of exempt resources, household goods, personal items, TVs, you know, the things that are in an individual's house are never counted. You don't even need to provide an inventory or anything else like that. An individual is allowed to own a residence. They have to live in it, but they're allowed to own a residence. That's an exempt asset. An individual is allowed to own a vehicle. Even if an individual can't drive that vehicle, an individual is allowed to own a vehicle that obviously can be used to support that individual. Exempt assets or resources, also an irrevocable funeral contract, burial plots, life insurance that has a face value of less than $2,000. Sometimes SSI sends out a notice that says we've underpaid you, and so we're going to make up for that by sending you a lump sum back payment. And those are exempt for a period of 9 months for SSI purposes, but Medicaid only exempts them for 6 months. And so there's a little difference there. But the biggest exempt resource, and obviously what we're here to talk about, are the special needs trusts, the pooled trusts, and the third-party discretionary trusts. Okay. SSI, again, it's means tested. your accountable resources need to be less than $2,000. So we just talked about what resources are, what exempt resources we have. If you have available assets or resources of over $2,000, then you're not qualified to receive SSI. Your income has to be low. And we talked about the disregards, the earned income disregard, the unearned income disregard. But it's $783 that you get from SSI. That goes up a little bit every year. And basically, if you're earning more than that, then you're likely not going to receive a big SSI bill or a paycheck. Qualifying for Medicaid, I mean, this is, again, really basic. Medicaid is the payer of last resort for healthcare services. Health insurance, home health aides, prescription drugs, DME. It's administered in all 88 counties. Then there's an Ohio Department of Medicaid that oversees the 88 counties. But Medicaid is a federal program. Ohio, who obviously accepts federal Medicaid funds and has a Medicaid program, cannot make a rule that is more restrictive than the federal Medicaid law. And so in my career, I've been involved with a number of lawsuits where Ohio has inappropriately created rules that were more restrictive and more punitive than the federal law. And so when there's a Medicaid issue from a legal perspective that arises, the first place I look is the federal law. And then I check to see if Ohio's administration of that law or their rule in any way violates that. But again, it's the same eligibility requirements for Medicaid as for SSI. It's $2,000 for a single individual, and then you got to have less than $783 a month in income. The Medicaid waivers are really important to a lot of people. Services to assist a person who requires a certain level of care to reside in the community. So there's the IO waiver, level 1, home care, assisted living, and passport. The income limit is higher. It's 300% of the SSI rate. So this year, the special income limit for all the waivers is $2,349. If your income is less than that and you otherwise qualify for Medicaid resource-wise, then you can get Medicaid and then the waiver services that are paid for by Medicaid. The Medicaid Buy-in for Workers with Disabilities program, which I've mentioned, is an awesome Medicaid benefit that really permits, it gives an opportunity to individuals to receive Medicaid, which they need, while working. There are many individuals that decide that they're not going to worry about Social Security disability because they want to work, they can work, and they're going to earn more than that $1,260 a month. But the Medicaid Buy-in for Workers with Disabilities program allows you to earn, what is this? You can earn $2,659 a month from your earnings, and you can have up to $12,382 in available assets in your bank account available to you and still get covered by Medicaid. And so it's not perfect for everybody. It's absolutely perfect for many people, though. Okay, a note about food and shelter and in-kind support and maintenance. I want to talk about the presumed maximum value. So again, an individual is living with mom and dad, obviously, and then they turn 18, they qualify for SSI. There's no room and board agreement in place or anything. SSI is going to look at them not paying rent, receiving food and shelter from a third party or another source as in-kind support and maintenance. And the reduction of SSI is going to be this calculation here. It's 1/3 of the own household medical needs standard plus $20. And so that's for 2020, it's $281 deduction. Okay. So unless you're certifying to the Social Security Administration that the beneficiary is paying their fair share of the household expenses, or you put a room and board agreement in place and provide that to Social Security, they're going to reduce SSI for an individual living in another person's home by $281. Again, to get around that, in many cases, you can, and this is for cases when particularly a beneficiary lives in an apartment or something like that. You can take money out of the trust and you can put it into a stable account and then pay rent and pay for food out of the stable account. And that is not going to be considered in-kind support and maintenance from the trust, because the stable account is deemed by Social Security to be the beneficiary's money at that point, albeit exempt. So that's a new development that's made things a lot easier in the past 5 years now, as the stable accounts have kind of taken off in Ohio and across the country. All right, so a brief case example here. John receives SSI. John's mother gives him $50 every month for food and cigarettes. Now, I want to make I want to point out that this example comes right out of Social Security's, what they're called POMs, the Programs Operation Manual. And I think it's funny that in the Social Security rules, they give an example of mom buying food and cigarettes for their beneficiary. So I've always kept this in because I get a kick out of it. But anyway, John's mom gives him $50 every month for food and cigarettes. That's countable unearned income to John. So his SSI will be reduced by $30 each month. That's the $50 value of what she gave him minus the $20 disregard. John's mother, trustee of his special needs trust, gives him $50 every month for food and cigarettes from the trust. So it's not from her, it's from the trust. It's the same result. Okay. But if John's mother purchased $30 worth of food and $20 worth of cigarettes each month, instead of giving him $50 in cash, only the $30 food purchase will impact his SSI. SSI will be reduced by $10 each month, which is the $30 value of the food provided to him minus the $20 disregard. Now, I mentioned earlier how difficult it is for Social Security to get this right. And again, they'll go back over, when they decide to review the case, they'll go back and try to figure out what John was given in any given month and how much his SSI benefit will be reduced. And again, that's when sometimes you get these letters that say, we overpaid you by, $1,200 last year based on this month and that month. And it's very difficult. So the moral of the story before I go on here is, don't give any cash or don't buy any food or shelter for a beneficiary on SSI. Instead, put the money in a stable account or buy the non-food and shelter directly. Okay, that's the moral of the story, just to keep it simple. If John's mom only purchased $20 worth of food, then John's SSI will not be impacted at all because there's the $20 disregard. Okay, a brief word about what a timeline that you have all been living. We already mentioned that prior to the age of 18, a parent's income and resources are no longer deemed to the child, and so 18 is a big age. SSI and Medicaid eligible if the child meets the disability test that we've discussed and the income and resource requirements that we discussed. But also at age 18, the parents are no longer the legal decision makers for the child. And so the question is, do we need to apply for guardianship? Or are there alternatives like powers of attorney that we can put in place so that we continue to legally conduct business on behalf of our child, take care of the finances, protect finances, talk to doctors, arrange for all of that. And that's a difficult discussion. Well, sometimes it's not. Sometimes it is, though. And a lot of times people choose, if possible, to just start with the powers of attorney. If the beneficiary is capable, has capacity to sign the power of attorney and see how it goes. Because applying for guardianship can be sometimes you have reporting requirements when you're in guardianships, and a lot of times it's on autopilot. But if there's any assets to deal with, you have to ask for permission to spend, and you have to do at least biannual accountings and things like that. So that's a topic for another Zoom call, is what to decide on guardianship and what you can do otherwise. Again, the payment of food and shelter by a parent at this period of time at age 18 is categorized as unearned income of the child, and we talked about how to deal with that. Now, for an adult, when the parent retires, the child again becomes eligible for childhood or child disability benefits. If the disability occurred prior to the age of 22, where they'll receive half of the parent's benefit. And when the parent passes away, it goes up to 75%. And so we don't know when that's going to happen, of course. When mom or dad retires or pass away, we can kind of game it out and estimate that. But it's also a good tool to know for planning purposes, to know what an individual's income is going to be, to decide how much money to put into the trust, how much to direct into that trust. So when you're gone, what's the trust going to need in order to take care of my son or my daughter? And if you know what the income is going to be, or generally what the income is going to be, and that they'll have Medicare, I mean, it's a great planning tool, really. Okay. Okay. So there are two types of special needs trusts, and I'm really going to start talking only about the types of trusts here, and then the stable accounts, and then we'll kind of wrap this up. I want you to think of the two types of trusts for disabled beneficiaries in the following context. Whose money is going into the trust? If it's the beneficiary's money that they're legally entitled to, then it needs to go into a Medicaid payback trust or a pooled trust or a stable account, okay? So anybody else's money with planning needs to go into a third-party discretionary trust. The self-settled trusts have a Medicaid payback provision, which we've mentioned. The compromise that Congress made in 1993 was that an individual who had money that needed Medicaid can put their own money, or money that they're entitled to, into a special needs trust, as long as when that beneficiary died, Medicaid would be reimbursed. That was the compromise. That's what makes it exempt, okay? That does not apply to mom and dad's money or any else's money for that matter. So a third-party discretionary trust, which is what parents set up for their kids through their estate plans, does not have a Medicaid payback provision. And it's very, very important when you're conceptualizing these different trusts, that you just focus on whose money is in this trust, okay? If there's a third-party trust already in place and a Medicaid payback trust already in place for a beneficiary, and that beneficiary scratches off a lotto ticket and wins $10,000, that money cannot go into the third-party trust, because that third-party trust doesn't have a Medicaid payback provision, okay? So it'd have to go into the Medicaid payback trust. If in the same scenario where there were two trusts in place and Aunt Susie wanted to give a substantial gift to the beneficiary as part of her estate plan, she would want to direct that gift to the third party trust because it doesn't have a Medicaid payback provision, because Aunt Susie's money's never belonged to the beneficiary. You can put it in a vehicle, this third party discretionary trust that is exempt, can be used just like any other trust for whatever they may need. And if something happens to the beneficiary, it can remain in the family or go to whomever the person wants it to go to. So the other example I would give you to drive this point home is if there's a beneficiary that has these two trusts, both of them are in place and both of them have money in them, which trust are you going to spend down first? You would use the money out of the Medicaid payback trust first, because when that's exhausted, or if it ever is exhausted, then it would have to go back to Medicaid anyway. So use that first and keep the money in the third party trust intact, so that it can be saved for the family. So if you leave with anything today about any of this special needs trust talk, it's that point. That's what I want you to remember, because it does get confusing when you're in the thick of it, of which trust monies should I use first? And, you don't want to put any of the individual's money in the third party trust, because then there's at least an argument that it could kind of soil the rest of the trust, and that somebody would require Medicaid payback. So just take that for what I've told you 3 or 4 times now. Know whose money is going into the trust. So again, yeah, I mean, I'll just repeat myself again, but third party trusts are funded with assets which never belong to the disabled beneficiary. And again, these are trusts that are typically done as part of estate plans. Purposeful estate planning for a family involves creating a third-party trust for a disabled beneficiary, oftentimes not to be funded until something happens in the future, like mom or dad pass away. The Medicaid payback trusts are typically created and funded when we need to shelter money now. There would be no reason to create a Medicaid payback trust for some future event that was unforeseen. You can create a Medicaid payback trust, at any time. You get an unexpected inheritance or an unexpected windfall, you can create the Medicaid payback trust. You want to create the third party trust ahead of time so that you can direct the assets into that and not to the beneficiary. A lot of times the Medicaid payback trusts, and this is the self-settled trusts, or I'm just going to refer to them as Medicaid payback. So you always remember there's a Medicaid payback on those. Oftentimes, again, they're established when there's an inheritance, when there's litigation proceeds, like those birth injury cases I was mentioning earlier, child support and castle cases. So there's an Ohio Supreme Court case that from the 80s that said that an individual receiving child support who is disabled may continue to receive child support into adulthood based on their disability. And we call those castle children. Now, child support is deemed to be income to the child or the person receiving those child support payments. And so a lot of times we'll direct the child support into the Medicaid payback trust to allow the individual to keep their countable income lower. And then sometimes, and this is becoming more and more rare when there's an improperly drafted third-party trust. I saw a lot of these early in my career, trusts that were drafted in the 90s, late 90s, early 2000s, before this area of the law became very clear in 2008 when the Ohio Supreme Court set this out for us. But a lot of times we would just throw in a Medicaid payback provision into an improperly drafted other trust to make it compliant and exempt. Now, a Medicaid payback trust can only be established by, the Medicaid payback trust can be established by an individual themselves if they have competence to do that. it can be established by a parent, a grandparent, or a guardian through the probate court. But a cousin, an aunt or an uncle can't create that. So that's something you need to pay attention to. And, I said there would be no reason to establish a Medicaid payback trust ahead of time. The only way I would establish it ahead of time is if you anticipated that an individual was going to come into money that they are entitled to, and that's going to be some point in the future, and you're worried that there isn't going to be one of these individuals that can establish the trust. So parent can establish it now rather than the guardian having to do it through probate court. So I don't mean to get too far in the weeds with that, but it is important on who can establish this. The other critical part about this is that the beneficiary has to be disabled, but also it needs to be funded prior to the age of 65. And so you can't set up a Medicaid payback trust for an individual that is over the age of 65. The reason for that is because Congress didn't want these Medicaid payback trusts to be something that the elderly used to achieve Medicaid eligibility for nursing homes, which is another, that's the other side of our area of practice is elder law, and it's all related, because Medicaid for nursing homes is the same Medicaid essentially as the waivers, really. But we can't use that for our elderly clients in nursing homes because of this 65-year-old restriction here. And of course, there's a payback provision. Okay, the greatest development, I think, in the area of special needs estate planning in the last, in some time has been the ABLE Act and the stable accounts. And the stable accounts, the Ohio program is called Stable. That's State Treasury ABLE account. And you can go to stableaccounts.com. And that is Ohio's website for the stable account. The stable account run through the Ohio Treasurer's Office is the best in the country. It is fantastic. And Ohio has done such a good job with it that I'm really proud to be a special needs lawyer in Ohio because of the stable account. I did a presentation in Florida at a special needs conference last October with Doug Jackson, who is basically the head of Ohio stable accounts. And he just did a phenomenal presentation about what these stable accounts are allowing individuals to do. And I want to give one sort of heartwarming, in my eyes, example. There's an employer in Marysville, Ohio, who employs a lot of individuals who can work but have disabilities and are reliant on Medicaid and SSI at times, but particularly for Medicaid. And he was having to not contribute to their 401k because contributions to their 401k were making their savings and their countable assets over the $2,000 threshold, and it would interrupt their benefits. So they were denying, or they were, not accepting all the full work benefits. When the stable accounts were established, instead of contributing to a 401k, he would contribute to a stable account set up for them. And those can be funded with up to $15,000 a year, plus a little more of an individual's own income. And it was actually a news story. And it was really heartwarming, but it actually showed how important these stable accounts have become to allow individuals to have a savings account of their own that they can look at, see, and use and see money that they've never, a lot of these individuals, as you all know, have never had an opportunity to see their own money that they have access to grow or have any sort of freedom to use money to spend it on something that they want or need without having to ask for permission from a trustee or mom and dad being worried that we need to be really careful about, is it for rent or food or shelter or anything else like that? And I mentioned earlier how useful these stable accounts are now with paying for in-kind support and maintenance needs like food and shelter and rent and things like that. And again, if you have an individual that's living in an apartment in the community and receiving Medicaid waiver benefits and perhaps SSI, the trustee paying the rent would reduce their SSI amount by that presumed maximum value. So now the trustee can put the same amount of money in the stable account and then pay it out of the stable account, and it totally gets around that that in-kind support and maintenance penalty. Now I realize that, what does that mean? This is like basically a shell game. You're just moving money from one place to another, but it makes a big impact for the individual beneficiary. And so if you haven't done so, I would just get on the website and make yourself familiar with it. It was originally designed, or conceptually, it was to put special needs lawyers out of business, so that people wouldn't have to have us draft the Medicaid payback trusts and things like that. And I mean, I think it's a pretty empowering concept that you can just have an account. The kind of problem is that they put these caps on it to make it financially viable, whatever that means in today's world. It originally didn't have like an age cap, and the yearly contribution equaled the total 529 cap. And so it was going to cost $19 billion over 10 years. Again, whatever that means. So they scaled it down significantly, which reduced some of its usefulness, but it's still a great tool in our toolbox, again, in conjunction with the other trusts. And so again, now there is an age restriction. You have to be blind or disabled prior to reaching the age of 26. So add another important age into all of this. You need to be receiving Social Security benefits based on a disability or otherwise meeting the Social Security disability test. You can also self-certify, but that would require you basically, under oath, certifying that you indeed are disabled but have never really applied or something like that. And you need to show a diagnosis and put a doctor's contact information down, and you could be audited for that. So let's see. ABLE accounts can be opened by the beneficiary themselves or the beneficiary's parent, guardian, or power of attorney. Any person can contribute to an ABLE account that an individual has. You can change the beneficiary, change in beneficiary allowed for siblings. There was some newer developments that allowed 529 college savings accounts to be rolled over into these new stable accounts. What's interesting about the ABLE Act is it's actually an amendment to the Internal Revenue Code Section 529. So they're related to these 529 college savings accounts. And so it's really nice now that maybe individuals who have established 529 accounts for their child, but may not be able to really use it because there aren't going to be, tuition needs or things like that. They can roll them into the stable account now, which is a great benefit. So now you can only put $15,000 into the stable account every year. Now you're also allowed to add the individual's a portion of the individual's income, and I think that an additional $10,000 or $12,000 of an individual's income can go in. But once you've met those limits, at least Ohio Stable won't let any more deposits in. But that is one of the limitations. If an individual gets an unexpected inheritance of, $50,000 from a long lost relative or something like that, you still need to use a Medicaid payback trust to get eligible, to maintain Medicaid eligibility. So this didn't solve all the problems, and this is one of the reasons why, because there's this cap. There's a total balance. So if an individual is on SSI and the stable account reaches $100,000, their SSI benefit is going to be suspended. And the total cap is always Ohio's 529 cap. Last year it was $462,000. I wasn't able to actually find this year's cap, but it can't be any too much more than that. But think about that. I mean, if you can only put $15,000 in the account every year, plus some of your income, it's going to be a long, long time before you ever get to that cap. Maybe never. There is a Medicaid payback provision. It's slightly different than the Medicaid payback provision in a Medicaid payback trust, because the Medicaid is only paid back out of a stable account from the time the account was established going forward. Whereas a Medicaid payback trust, the Medicaid payback is a lifetime reimbursement. Okay. I don't know that that's ever really going to be a big issue, again, with the amounts, with the smaller, relatively smaller amounts that we need to put in, that we're allowed to put in these. So you can use these accounts for what are called qualified disability expenses. And there's a long list here, a list you've probably seen, but here's the deal. You can use a stable account for anything that benefits the beneficiary, anything they desire. Some of the rules that were written, or the examples in the rules that were written, specifically said to buy television at a retailer, or cell phones, or as long as it's for the individual's benefit and it conceivably makes their life better, it'll be considered a qualified disability expense. In fact, I don't really know of any examples, hard examples that we've been given that weren't considered qualified disability expenses, as long as those were made in the proper context, for the sole benefit of the individual.
So any questions, keep your share screen on, because if you don't, you'll just see everybody.
That's all right. Okay, so let's go through the questions.
During COVID, my son.
Okay, so first one. During COVID, my son earned temporary extra COVID bonuses, and these put him over 1260 for 4 months of this year. He had one overage last year during a 5-week month. How do we handle this with SSI and SSDI to maintain benefits? The employer is implementing an ongoing bonus structure with an annual bonus, which pushes him over 1260 be an issue. So there is a trial work period for Social Security benefits, and it's a period of 9 months. It's way too detailed to go over in this discussion. So if what I'm seeing right now is, if earned income was over that 1260 for 4 months and then 1 month of last year, you're still well within that 9-month trial work period. I'm not even sure that that bonus, COVID bonus or whatever, would be considered to go over. It's a tough one. Because it's related to COVID, honestly, I'd be happy to dig into this and talk to you about it. Again, I don't think it's a problem now, but I would be really concerned if it continues. I mean, I think you're saying that this bonus is going to continue, and you may want to consider not taking it. But then that gets into, are you leaving money on the table? I would be interested if your son is currently receiving SSI or SSDI. It looks like he is, but this is a good question. It's a very particular issue. So if you want to schedule a time to talk with me, I'd be happy to do so. Next question, can a trustee and guardian be,
He says he is on SSI now and under review for SSDI.
okay. So the individual is on SSI now and under review for SSDI. Yeah, I would be cautious about ongoing monthly earnings over 1260. And we should look at that together if you'd like. Okay, next one. Can a trustee and a guardian be rep payee? Yes, the trustee can be a person could be all three. The trustee of a trust, the legal guardian appointed by the probate court, and the rep payee through Social Security. Now, what's funny about Social Security, as many of you probably know, is that the rep pay, you could be power of attorney, you could be guardian, you could be anybody in the world. They only care about who the rep payee is. They don't even honor a power of attorney. It's really phenomenal how they pretend that like state law doesn't exist. The only thing in the world that matters is SSI's rules. But no, one individual can be all three, and those are all three different roles. So, and a lot of times it's the same person. Do HMO fees count as rent, and can they be paid out of a stable account? HMO fees. Are those like a homeowners association fees? There's the message. Condo fees. Okay, so condo fees, they can be paid out of a stable account, and they would be considered in-kind support and maintenance. So yes, that would be considered part of rent. But again, those can be paid out of a stable account. Next question, will this be sent as a recording? My internet went out for like 20 minutes. Thank you for this. Yes, we've recorded it. We're recording it now, and we'll make it available to all of you next week. All right. Okay. Should room and board payments be made from a self-settled trust and not a Medicaid payback trust? Should room and board be made from a self-settled trust and not a Medicaid? It doesn't matter where the room and board payments are made from. So if they're made from a third party, they will count against the individual receiving SSI. I don't know if that made sense, but if you're the trustee of a third party trust or a Medicaid payback trust and you are paying for a beneficiary's rent, their SSI will be reduced. So what you can do instead is, instead of paying the rent, you would put the money into a stable account and then out of the stable account pay the rent. And that avoids that being seen as in-kind support and maintenance. Okay. Next one, please explain the types of expenses that can be paid to my son. We have a third-party special needs trust, which is effective after we're gone. Can he have a voucher to purchase those items monthly? It's an excellent question about how this works. And the answer is the trust can pay for anything that the beneficiary needs, as long as it's for the beneficiary's sole benefit. And there's always considerations that, like we've been talking about, you know, rent and food and shelter costs and things like that, that we want to be sure we're doing it in the proper way, running it through a stable account or something like that. But the trust can pay for anything else. And so if there's monthly YMCA fee, if there's a bus pass, there's tuition payments, there's subscriptions, Netflix, cell phones, everything that we pay for and live on, can be paid out of these trusts. And again, what has been such a great development in providing access to things for beneficiaries are these stable accounts. And so if you can have a stable account established where you can, as trustee, feed that stable account on a monthly basis and have either a guardian or the individual themselves, if they're capable, they have a debit card that then they can use at the grocery store, at the gas station. That stable account can pay those monthly bills on a recurring basis. You can set these things up so that they're paid out of that, and that is funded. And frankly, I wouldn't fund it, particularly out of a third-party discretionary trust. I wouldn't fund it with particularly or a whole lot more than what is needed, because remember, the stable account still has a Medicaid payback provision. So you don't want to build it up too high when you can leave it in the third-party trust. And so, it's not a question of can he have a voucher to purchase those items monthly. We have tools in place now where it can go into a special account, and then there can be and used like a dedicated bank account that magically doesn't count against them for SSI for Medicaid. Okay. All right. Next, when looking at a third-party trust, what is the difference between parents' money that is used to fund the trust, never money for the beneficiary, and an inheritance for the beneficiary? So another great question. How am I going to do this? Let's say 2 examples. Mom and dad set up a third-party trust that is going to be funded when they both are gone through beneficiary designations and transfer on death designations and things like that. So mom and dad are gone, and the trust is funded through their estate plan. Outside of probate, it goes into that trust. And let's say there are 3 kids. Child 1 gets an outright distribution of 1/3. Child 2 gets an outright distribution of 1/3. And child 3 is disabled, so we hold it in trust in this wholly discretionary trust that doesn't count, okay? That allows families now to protect their disabled child's inheritance without it ever actually getting to them. Now, the second example I'll give you is that you don't do anything, and you don't put in place a third-party trust. And so at death, child 1 gets 1/3 outright distribution, child 2 gets outright 1/3 distribution, and disabled child gets an outright 1/3 distribution. All of a sudden, that is disabled child's money. They're entitled to it. It's their inheritance, but it's not protected in the third-party trust. So what would we do then? We'd have to put that inheritance into a Medicaid payback trust because it went to the disabled child. And so that's why the planning is so important, to prevent an inheritance from making it all the way, legally entitled to the beneficiary. Okay. I hope I answered that clearly enough. All right. Well, that's it. That's all the questions. I'm sure you'll have more. And if you do, there's, nothing that would prevent me from wanting to chat with you. And so you can call and schedule a time to speak with me on the phone, or reach out through email. And again, we'll provide the PowerPoint and some other information to you all early next week. So I thank you very much, and hopefully this worked out for all of you, and I enjoyed it, and we'll do it again in the spring, maybe in person, but hey, if this works out for everybody, we can do this. So thank you very much.